Anyway, so very, very exciting stuff going on. Let's look at the futures. Don't look at the futures. Holy crap. That's weekly. That's why it's very scary looking, isn't it? How's the hourly? Ooh, the hourly almost looks like we're recovering. Yeah, we're back in the green, except for the poor Russell, but at least the Russell didn't go any lower because it was about to make a new low. See how we love to make W's, but these are not healthy W's, because a healthy W would look like a W. This is a up and down blasty nonsense. If we pull back on the pattern to the daily chart, that's what the W looks like. That's called a broken W. Anytime you're trying to make a W and you fail to complete it, that's probably bad news. Okay, so whenever you see these little W patterns forming, you say, okay, we got one leg here, we got the up leg in the middle, and now we're going to go up. And if you don't make it up to here again, you're in trouble. As soon as you start failing, something went wrong. This is a normal pullback pattern, like come here, come here, come here, and come here. That's just some consolidation on the way up. But as soon as you start failing those, that means that there's been a complete loss of faith in this level, which is probably the level that this other run started from if you go further back. Oh, in fact, let's test that theory. Yeah. Well, I can't exactly tell, but see how you have you have a good W here, right? That's a bullish W. You actually improved. You went from here to here, and you actually went over that. Then you go, then here's another bullish W, right? Improved from there. And then we have a still bullish W, last one. And now we go all the way back to where the joy started and down here, and then suddenly it's no longer supported. Why? Something changed. What changed? Tariffs changed. The laws changed. The law of the land that supported everything the companies were doing back here is no longer the law of the land. Now we have new rules, and now we have to figure out under these new rules, how do the wait, 10-year spikes to 4.51 after hitting blah blah blah. Okay, bad. Come on, what are the auction rates? So CNBC is the worst. The worst. 10-year auction results. Today's auction results from treasury.gov. What? Waiting for that, I guess. Oh, this one.
Specifically referencing, you see a rise in interest rates and you see a weaker currency. Historically speaking,
what is this telling me? I don't think it's telling me anything. I don't think this is going to help.
Particularly in the municipal where people are selling.
Oh, come on, man.
You know, when the market is somewhat normal,
where's my buddy Bodie? Da, 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 da.
So I think that's also exaggerating things here too. I'm sure maybe the FUB, one of those kind of maybe ETFs perhaps any time possibly have. We've seen the prices selling off, and we all remember COVID, but that had launched that really bond-buying facility.
Mm-hmm.
It's not about whether there's probably people in the bond markets. The broader point here is making.
What does this thing say? Bodie collection, great. Okay. Only 103, but what? Do you have the results of the 10-year note auction. If anybody does have it, let me know. Dun, 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 dun. Come on.
Completely agree. We also have Jimmy up on standby. Let's layer you in here, Jim. You're saying, and I thought you had really
This is such an important auction, and I can't see anybody like reporting on it. Dow's up 500 though, so I got to think it went well. 4.39. Okay, so it went well. I don't have to look. All right, so that's a huge relief. The 10-year note auction went off well. I'm sure it was manipulated, but who cares? As long as it went off well, it doesn't really matter how we got there. So that's going to give us a nice relief rally. That was the fear. I mean, if yesterday's 3-year auction was a total disaster, and if we had 2 of those in a row, we'd be in kind of trouble. Hey, Google updated Gemini. GeminiGoogle.com. Supposedly they've got a new version out. No. 2.50 Pro experimental deep research with Pro. That's going to take too long. Okay. Let's do that. And let's ask it the same question we're still waiting for in Bodhi. Oh, he's got it. Based on the results of today's 39 billion auction, notes have not yet been released. Okay. All right. Determine feasibility. I like that. Gemini's big on it, shows you what it's thinking, which is kind of good actually. Have not been released. Well, I can see the 10-year rate is 4 point. It was 4.4, I think. What did I say it was? Why do I have 4? Oh no, it's 4.4. There you go. Hang on, maybe we can't sing till he's got something to say.
This was a stellar auction, a solid
Stellar auction.
The when issued market was trading about 3 basis points higher than the auction went off, and the yield at the auction is 4.435. So we stopped through like 3 basis points. That's aggressive price.
4.435 was the auction.
Ranges that we've had low to high.
And now we're at 4.4. 4.4.
Even bigger issue may be that maybe there are some investors that are keeping a level head that are using the big moves to yield to the upside.
Do you guys hear this? This is such bullshit.
Concession.
All of a sudden, they were really interested in the 10-year notes after nobody wanted the 3-year notes yesterday. It's manipulated. Somebody, the fix was in.
There's a lot of things going on that you all are going to continue to talk about. I would like to say, after all my years since the early 80s observing markets,
under 4.5 was our goal, and we made it. That's all we need to know.
We've seen, it becomes an issue versus liquidity issues versus liquidity problems. And I still think we're in the first camp. I never ignore all the signs because the big deal would be if this becomes more than a liquidation. I mean, don't forget.
NASDAQ's up 2.2%.
Many sessions ago that there was a flight to safety. Think some of these trades.
Oh my God. Oh, I can't believe how annoying these people are. Anyway, there's no information. He's doing a Mark Twain up there. It's like, yeah, I remember back in 1947 when I was a boy and I used to swing on swing set, and that would let me know what the 10-year was going to do. And I would ask Grandpa Joe what he was buying. I mean, for God's sake, give us some freaking information, you idiots. Supposed to be reporting on an auction. He's sitting there going off. I mean, there's zero information being conveyed. If it wasn't for the graphic on the screen, I would have no idea what actually happened at that auction. Ugh. Anyway, you know, usually I look. You guys know me. I can go years without caring. But I mean, when the markets are like crashing and things are critical, you need really good information. They've got to stop their bullshit and actually do their freaking jobs for a change. Oh my God, it's so awful. Now this is totally broken. No, if you can't hold the screen. No, I gotta shut it all down. Shut it all down. Whoop. Eh, I don't know what's happening. Look, see, there's supposed to be a screen, but it's not really there. Yes, I can see that an error has happened. Nope. I always gotta be careful because I don't want to shut you guys down. Let's see. There are no running apps. That's it's a very unhelpful task manager. What happened? And, oh, there we go. Got rid of it. Okay, hopefully everything's still running on your end. Looks good. Phil says words, green light goes on. Seems okay. All right. Now, on with whatever. Was there a topic to this webinar? Tariff fucking buying opportunities. Okay, well, so we got the first thing out of the way. It's a 10-year auction. I'm not going to spend much time on this, so let's talk about it, because in 1 hour, not even an hour, we have the Fed coming up. Where's Warren? Warren is absent. Gemini, we do not need you. OpenAI is where Warren lives. Log in. What is that? API platform, Sora? I didn't even know what Sora is. What is this? They didn't used to do that. Okay. Log in. You know who I am. Oh, temporary. Why does that say temporary? I don't know what that is. I don't know what that is. No, sidebar. Here we go. Bitcoin image. Was there any place where we discussed the Fed? Oh, Fed statement comparison. And this is from when? Ooh, there's no dates. Oh, yes, there are March 19th. Okay, that's a while ago. Okay. FOMC meeting in minutes and stuff. FOMC meetings. So we're waiting for these minutes. That means we have these from January 29th. There's probably a lot of stuff we don't need. Certainly don't need that. Good God. We do need all that though. Committee policy actions, the vote, blah, blah, blah. Voting against none. All right. I think. It seems like a lot of bullshit we don't need, right? Okay. Here's the last Fed minutes, and we're waiting for the new ones to come out. Are you able to? No, he's not going to be able to. He's not. This is an old warrant. He won't be able to browse the web as far as I know. All right. All right. So he'll just have to wait until we get the new one. To do a comparison. Trump has put, oh, should know. April 9th, 2025, and Trump has put his tariffs into effect, and the markets are down about 20% off their highs. The 10-year auction just went off at 4 point, what do we say it was? Let's say 4.4% is a little bit less, I think. The 10-year auction just went off at 4.4% after yesterday's shaky 3-year auction. All right, so he's just summarizing where we were in the January report. Key assessments as of January. GDP was on a solid pace. That's no longer true. Labor market stabilized. Okay. GDP per the Atlanta Fed seems to be contracting a good 2% in Q1 now. Is it Q1's report that they give or Q2? No, it's for Q2, right? Damn it, now I gotta check. Too important not to get it right. Minus 2.4% for the first quarter. Labor market stabilized is correct. Headline inflation, 2.6% in December. That's about right. Core PCE stuck, showing disinflation. I think core came down a little bit. Tariff impact already flagged as a risk to inflation. China struck back with Title long rates, easy credit. Oh, MO mortgage rates hit 7% today. High mortgage yields, easy credit for corporates. I think there are some liquidity concerns now. Unrealized losses, deal intermediation, balance sheet, QT to continue, 25 billion in treasuries, 35. They cut that down, right? So didn't they announce that at the last meeting? Oh, he doesn't have that. As you will see, QT has been trimmed considerably. All right, inflation risk tilted up. This is as of the January report, not a major, no policy move yet. The pause, what's changed since January? Here's what we'll compare. Oh, does he know this? That's good. So the January view, tariffs were seen as a risk. Now they are active. So the likely change he's expecting in the minutes is stronger inflation risk language. Continuing full speed, that's been changed. Slow. Oh, he knows that. See, slowed to 5 billion on April 2nd. Oh, very good. Full analysis. So he already knows this. See, it's weird with you never know with the ChatGPT, because sometimes the new things that they program affect only new things you open up, and sometimes they roll back, and somehow he's able to access information live. So market conditions, VIX low, equity, oh God. All right, so my VIX is low. Market conditions last time, VIX is low. Now VIX equities minus 20%, VIX greater than 25. Concern over stability, 10-year treasury, 3.9 now. So it was 3.9 in January, now it's 4.4. I mean, that's an expectation of inflation. It's up 0.5 point. Discussion of term premiums and liquidity stress. SEP program, GDP cut to 1.7%. Nope, it's even worse than he thinks. So expect reflection of downgraded macro view. Labor market was solid. Now it's still holding up, but there's claims are rising. Monitoring language, but not panic. Balanced outlook. Growing public concern that the yield curve is still inverted. That's not getting better. Liquidity and reserves abundant, and they're not abundant at all now. Wow, it makes you realize how negative things have turned. So here's what I'll be looking for in the minutes. QT slowdown, was it preemptive liquidity defense or concern about the credit markets? Expect detailed language. Inflation concern. Did the tariff-driven inflation change the tone? Are more participants seeing risk of policy error from tightening too far? Or loosening too far? Powell influence, he downplayed QT at the press conference. Is he leading a dovish camp or hawkish dissenters? Financial stability concerns. Okay, Warren will provide title and admitting somebody's planning ahead. Okay. As to what I'd like, you decide what should be emphasized based on the data. Let's make sure everyone is prepared for strategy shifts if necessary. All right. Oh, he's basing this on the changes I just told him. Trump tariffs. I see 104%. You're like, no, that's got to be a typo, right? Oh, that's good though. See what he's saying? The prior normal range. So in other words, it was thought to be 60%, and now it's 104%. So it's way worse than we thought. China tariffs 84%. We thought they would be 15 to 25%. So that's an export shot in manufacturing. Mortgage rates are now 7%. They were 6.1% in March. That was only last month. So that's a warning on housing freezing up. 10-year treasuries, 4.4% at the auction, 3.9% in February. So we're having liquidity and demand stress. The VIX is around 50. Normal is 15 to 20. 30 is stress. This is panic. And the S&P is 20% off the highs. Record high up in February 2 months ago. We were at record highs. Bear market onset is confirmed. The growth narrative just died at 24% GDP now. Estimate. Oh, no, minus 24%. Shit. Sorry, it's minus 2.4% on GDP now, not 24%. If that were the case, we couldn't afford the electricity to keep you running. Okay. Tariffs, retaliation, supply shocks, core goods prices. Hyper-nationalistic and protectionist regardless of global fallout. Liquidity stress brewing, 7% mortgage rates will freeze home sales and refis. Housing liquidity dies. 4.4% 10-year shows buyers demanding higher term premiums. Banks holding long duration treasuries. See, when you have a 7% mortgage rate, people who have 3.5% mortgage rates, which is most people who own homes, are trapped in their homes because you can't refinance. You can't sell your home that has a 3.5% rate and move to a home that has a 7% rate. You would have to significantly downsize your home. It's basically taking about 1/3 of your buying power away from you when you have to pay that much more of a mortgage. Then that's what he means by liquidity dies. You can't refinance your home. You can't sell your home. And even borrowing against your home at 7% is very painful. So it's very tough. And that's a big point of where liquidity starts drying up, is in things like that. And also the 10-year, as the 10-year goes higher and higher, that means that the US is $36 trillion worth of debt. Borrowing cost starts going higher and higher because most of the debt that we have rolls over within let's say 2 years. The average probably debt paper is 2 to 3 years of the US. So most of our debt is very short-term debt that we sell, and it rolls over constantly. And that's good on the way down because it refinances you quickly lower, but on the way up, it's incredibly painful because it means week by week and day by day, we are incurring higher and higher interest fees on our notes. And we foolishly did not lock in our rates when they were down, below 3%. When people were buying 10-year notes at 2%, we should have locked that in for 50 years. We should have sold 100-year notes for 2%. I mean, it's silly to have notes lower than that. You know why? We were greedy because we looked at Japan and said, well, Japan's selling notes for 0%. And we've had that conversation before. The main reason Japan can sell notes for 0% is because in Asia, they are considered a much more stable economy than most. Also, Japan only has a $5 trillion GDP, and they're only borrowing, they borrow a lot, they're only borrowing $500 billion a year. We're borrowing $7 trillion a year. There's a big difference. So it's easy to give Japan some money at 0% to just kind of hold your money for you and have some of your money diversified into yen. And yen is a major reserve currency. China's yuan is not a major reserve currency, and neither any of the other Asian currencies. So therefore, by default, money, especially if you're an Asian, of which most people are in the world, are Asian, if you're an Asian investor and you want to diversify your money, you're not going to give a proportional amount to Japan. So Europe is a $25 trillion economy. We're a $28 trillion economy, and Japan's a $5 trillion economy. And that's much, much less, obviously. It's 1/10 of Europe plus America, but if you're going to diversify your portfolio and you live in Asia, you're not going to only put 10% of your money in Asia. You're going to put more than 10% of your money in Asia. Therefore, Japan is overwhelmed with offers for their bonds because everybody wants to put their bonds in Japan, and Japan simply doesn't issue enough bonds to satisfy all the demand. And that's why Japan got in so much trouble. Japan has always gorged themselves on cheap currency. They've always been able to borrow money cheaply, simply because the yen has always been considered a strong reserve currency. Everybody feels it's safe and so on and so forth. And not only that, though, but the yen is also devalued against most currencies. So you're kind of betting that the yen will bounce one day. And if it doesn't, so what? You get your interest, you get your money. But if it does, you get a bonus from the bounce of the yen at some point. And that's happened. Those people are all winners right now, because if you look at the yen, no, let's look at a bigger chart. So only recently, but recently being the last year. But look at the yen. So the yen, if you bought your bonds at 63 yen, and when you get your money back, you're at 70 yen, that's 10%. You've gained 10% on your bonds because of the currency went up 10%. The currency the bond is priced in went up 10%. Whereas if you were dumb enough to buy dollar bonds, okay, it's the opposite story. It went down, well, let's say it went down 5% or whatever. But so if you bought dollar bonds, the dollar drops 5%. So even though you're getting better interest, the drop in the currency wipes out your gains. So that's another consideration in bond markets, and they never talk about that. And they never talk about that because people get confused. And the TV people assume that they're talking to the dumbest possible audience, and newspaper people assume that they're talking to people who only want to read an article for 3 or 4 minutes. And so they can't go off on tangents either. There's not many papers that let them, because you got to fit in. You need a person's eyeballs to look at an article for a certain amount of time and read a certain amount of ads. That's all they care about. They don't give a shit whether you are educated or entertained or whatever. They only care that that they get your focus long enough to show you some ads. That's the whole. It's got nothing to do with anything else. So where are we now? Okay, we're done with Warren. He's ready to go. We have a half hour until the minutes come out, and so I guess that means we should spend our time talking about what do we want to buy. Aha. La da da. Is this gonna go? It's a little slow. Any questions? Oh, somebody has a big question. That's a long one. All right, let's see what happened here. Who's asking this? Daniel. I'm not sure if it's okay to ask this kind of question. I currently have the following position. I've been trading options with your site since October. I've rebalanced my portfolio and bought back most of my puts. That's good. I set up the following hedge. SQQ purchased 15 January 16 34 calls at $8. I sold and bought back and resold the short 50 calls. So he had basically the 34.50 spread. I'm not sure if that was the right move. Well, I mean, it depends on your timing. But let's see. So you have the, oh, and you sold the June 50 calls. I've sold and bought back and resold the 50 calls. That sounds good to me. Then you seem to have asked it again. Oh, then you give prices. Okay. Okay. So then he does it again with prices. Okay. So he bought the 15 calls. No, wait. He purchased, I'm confused. 15. It looks like he purchased 15 of the 202634 calls. He sold 15 of the June 20 2025 50 calls at 11. So, well, first of all, you have a positive on the spread. You bought your calls, you bought your 34s for 8, and you sold the 50s for 11.54. And I guess you went in and out in between. That's perfect. You should be thrilled. So what's the question? So you're left with a free spread, and essentially it's a net credit spread. So if it expires worthless, you still get $3 out of it. I'm not sure if that was the right move. It sounds like the perfect move to me. I left the spread. Well, if you still need hedges, if you still have longs and you still need hedges, you still want the spread. It's in the money or at the money. SQQ is right about $50. So the only way you don't make money is if SQQ goes lower. I'll take a look in a second. I think there might be a way to handle this. So I'm not sure if that was the right move. I let the spread run its course. Was this a good position to be in, or do you have any suggestions for repositioning? I pressed an enter by mistake. Thanks for your help. I pressed enter for mistake. Okay. Oh, market up 2,000. Yeah, because the auction was, well, I mean, that's a lot. But it's like I said, though, in chat the other day, that the money has nowhere to go. All this money is coming out of the market, 6 trillion, 10 trillion, whatever dollars it is, and it isn't going into bonds because nobody really wants the bonds. It's not going to housing because housing is a mess. So what asset class? And it already went into gold, but gold's not that big. Bitcoin's not that big. Bitcoin's only 2 trillion total dollars, the whole thing. So Bitcoin's not that big. Gold isn't that big. Where are you going to put $10 trillion of liquidated money that just came out of the market? Where does it go? Nowhere. It's sitting in people's accounts and their trading accounts because you're not going to put it in the bank because the bank doesn't pay you any interest. So it's all just sitting in trading accounts. And the second people think that there's a bounce and they might be missing something, they start running back into the market because they're like, oh my God, I'm going to miss out on the thing's cheap and it's got to get blah, 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 blah. You know, it's like that. So yeah, that's fine. To some extent, that's what we're doing. We're buying. In fact, that's where I was going to. We're buying back some of the stocks that got cheaper on us. We're very happy to do that. You don't want to miss a big move back up, but also you don't want to be the idiot that buys a bounce and then it goes even lower. So we're trying to just sort of, you know, walk that little high wire right now. Ooh, 90-day pause. Oh. That's funny. Oh my God, the NASDAQ is up 9%. There's a 90-day pause. Thank you, whoever said that, Moses. There's a 90-day pause on non-retaliating countries. Oh my God. So they just paused the whole fucking thing again. Wow. This administration is psychotic. Oh my God. So the Dow is up 6%, 2,300 points back to 40,000. The 10 years 4.35. The S&P is up 350.7% in a day. Oh my God, I'm so happy we made those buys. This is exactly what the FOMO is about. All right, so anyway, hang on, let's do this one thing at a time. How crazy. Oh my God, after they just said that they're absolutely going to stick to the tariffs, they postponed them for 90 days. Wow. But this is what we were worried about. This is why we took some of our hedges off the table the other day, because we wanted to cash out a little bit just in case something crazy happened like this. But this is going crazy beyond crazy now. Holy shit. Indexes aren't supposed to move 7% in a day. Anyway, so like I said, money sloshing around the sidelines, blah, 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 blah. All right, so anyway, is this Daniel? I'm confused. I guess it was Daniel. All right, Daniel. So we're not going to spend a lot of time on your thing. The bottom line is, though, you're fine. Okay, so you're fine. What I would do is I would take those 34 calls and I would roll them back to a 2027, like maybe a 40-55 spread. That should be pretty cheap. You should be able to get a 2027 40-55 spread for a good price. And ask me in chat. You know, I'll be happy to do it in chat, just not taking up everybody's time. But that way, you'll still be covering your short 2026 calls, but with the assumption that we're probably not going to go much lower than we are now on the NASDAQ, and therefore you want to start cashing out. Plus, you also are buying yourself insurance for the next year after that. It's insurance. So, you know, the less cash you have in the insurance policy, the better you are. So, and eventually, if you have a free insurance policy, that's the best way to protect yourself. So, holy cow. Oh my God. Okay. Wow. Wow, wow, wow. I don't even know what to say. All right. But I just want, I want to say this is how you play the market. This is exactly what happened. We got to our 20% level. It was the bottom of the range. I don't know if this is the day I did the SCP. La, la, la. It's either here or Monday I did the STP stuff. Guess it was Monday. Monday, bloody Monday. All right. Bill's posts. All right, so Monday was yet another disastrous day. But nonetheless, we have disciplines. And so here we are at the bounce chart, and we've hit our goals. Our goal being, this is how far we thought we would hit. This is how far we thought we'd go on the bounce chart before you know, it's a 20% drop, basically. That's what we're looking at. So these are essentially the 20% lines. We expected a 20% correction. We know we got the tariffs, and we say, well, if that's the case, then we're probably, even if we're going lower, we're probably going to bounce from the 20% corrections. Therefore, we should get to these weak bounce lines. If we're going to get to these weak bounce lines, then, and we don't know for sure that we're going to stop there, but we say we should at least get to the weak bounce lines, maybe the strong bounce lines. That's a pretty significant move. That's 40% back on the correction. So therefore, if we're going to go, and in this case, if it's 20%, that means that's an 8% correction. By the way, 8% correction, that's what we have right this minute. Those 8% gains that you're seeing on the market right now are hitting our strong bounce lines. NASDAQ 16,472. NASDAQ, well, not really. So what? Oh no, that's not the composite. 18,7 something for the Russell. Okay, so it's 187 something for the Russell. The Dow, the Dow is up 2,000. The Dow is, like I said, the Dow is just under 40. There's the Dow just under 40. Here is S&P 5280. So you see where we are? We're moving into the range of these strong bounce lines. That's an 8% move. When you have a 20% drop, each of these boxes is going to be 4%. So 4%, 8%. So all we're doing right now is that we're reacting to positive news, except on a crazy accelerated scale where we're bouncing the entire way to the strong bounce line on one piece of news. Now, but that one piece of news is very significant. There's no tariffs now for the second quarter. We are in Q2. Q2 started, 9 days ago. We're in Q2. There will be no tariffs in Q2 other than whatever bullshit we're doing with China. That's a massive change. That has now changed things significantly. So the reason we started selling off like crazy was the tariffs. So now we're going to go back, and this is fantastic. So these are going to be very good results. But we didn't know that here. We thought Trump was being insane and wasn't going to change his mind. So even so, though, we still expected a technical bounce. And I said, Europe says they want to negotiate 0 for 0 tariffs. Tariffs are likely to be legally challenged as soon as Friday. This is why we took the STP gains off the table Friday. I said it wouldn't take much of anything to bounce us, blah, blah, blah. So on Friday, we already did take off some gains. Here we did more, or I'm sorry, we looked at it to do more. Trump will consider a 90-day pause with countries to negotiate. So it's really Friday that we made the changes. I apologize. What did I write down here? Yeah. So we had moved things around and changed our TZAs. And what we did is we had the 10s and we rolled. In fact, that's what I just told Daniel to do. We had the 10s. They were deep in the money on TZA. We cashed them out because they were worth more money than if we wrote out the spread, it wouldn't be worth as much as they're worth right now. So why wouldn't we take that off the table? We took it off the table and we picked up a very large spread. It's a $10 spread times 1,000 contracts, makes it $1 million spread. And we left our short calls. Our short calls were these, the 45s are too far out of the money to care about. We're at 24. These are never going to happen, so we consider them dead. These 700 calls, 900 calls. So these 900 short calls, we have the January 20 short calls that are basically in the money, but they're only $4 in the money. And look at this, they're being priced at $10. So $6 of that is premium. So we took the money on our 10s and ran and left these short calls for the premium to wear down. Even if TZA goes higher, that $6 is still going to disappear between now and January. Then we had the short Julys. Ooh, like that. We had the short July 17s. They're $7 in the money, but they're priced at $8.90. So that premium is going to go away by July, and then we could roll those to a higher strike. What higher strike? Well, look at that. We could roll them up to the 20s easily, right? Because the 20s are more money than they are, but they're going to lose premium. So they'll be down to like $7, and then we're going to roll them to something even higher than the 20s. If we have to, or if TZA recovers, then we may not have to roll them at all. They may just expire worthless. And there we are with it, exactly what I told you, Daniel. There we are with our new 2027 spread, right? That gives us coverage for another year after the one that we have. 10-year 4.36. What's it down? Dow's up 2,000 at 6%. S&P's up 327 at 6.5%. Wow, this is crazy. Everything's crazy. It's so fun. So then I talked about, minor adjustments here on the hedges. I don't think we adjusted these other hedges, though, so we already did it on Friday. But those are the adjustments we made. In SQQ, we see how we have 950. We used to have, I think, 1,200, and we dropped it to 950. So we sold 250 of these. We actually sold 250 of the 20s because look at what they are. The $20 calls are $36, but the spread is only a $20 spread, so there's 16 bonus dollars in that. So of course we sold it. We didn't sell them all. We sold 250 out of 12. Then we took this 250 here. We didn't buy it back. We rolled it to the September 47s, I think it was. Yeah. So we rolled it to the September 47s and some January 45s too. All right, so that's our short calls now at a strike that we think if the Nasdaq recovers will oh, I'm sorry, it's only these 45. This is TZA, you got confused. Oh no, 47 and 45. I see those are 45s too. So anyway, so we think that the Nasdaq should recover and back to 45, 47 by September. And if that happens, this goes worthless. We pick up, look at these numbers. We'll gain $1.1 million. $1 million from that, from the short calls. Meanwhile, our $20 hedges will still be in the money, and we've got the short 40s, and we'll gain $2 million on those. And even if we're right at 40, which would be perfect, if we're right at 40, these guys would still be worth $1.9 million. So we'd have 1.9 million left, and everything else would be wiped out. And currently that's net minus $1 million plus $1 million. So it's basically net zero, and we'd have $1.9 million left. So we gain $2 million if, in other words, if SQQ goes back to 40 from 54, if it drops $15, which is more than 20%, which is a 10% gain almost in the NASDAQ. So if the NASDAQ gains 10%, then we still have our $20 value on these, which would be $4 million. No, I'm sorry, which would be $2 million. So we still have our $2 million here, and all the rest would expire worthless, and that's often net zero at the moment price on this thing. So everything can go perfectly, and that's crazy because our hedge has already been successful. We just pulled $1 million out of it by selling the short puts. I'm sorry, by selling the long calls. By selling these long calls, we took $1 million off the table. That's already down here in our profit, in our cash anyway, not profit. And we took $1 million off the table, and now we have a net 3.4 minus 2.4 minus $1 million something is basically zero. So we have a net zero cost spread here, and if the NASDAQ is at 40-ish, which is our target. We're fundamentalists. We have targets. We believe there is an actual value to the NASDAQ as of the end of Q3. So that's our price target for the NASDAQ is still is basically about 5-6% higher than it is right now. And that depends on what happens with the tariffs and so on and so forth. But we'll see. We'll have more information by then. Mostly we want to see what corporate profits look like between now and then also. But point being, if there is a point we can keep track of here, the point being we took some money off the table, $1 million, boom, put it in our pocket. We left ourselves with a really good spread. We retargeted to something we feel is realistic going into the end of the year. And we have a $2 million upside even if the NASDAQ recovers. That's freaking fantastic. And that's just the Qs. We have another million something coming to us on TZA in the same situation. So we played for the bounce. And what happened today? We got the bounce. So feeling very clever. See, we had no chance. I said I feel exceptionally good about this setup. That was my summary of the situation as of Monday. As I said, I feel exceptionally good about this setup. Even with everything going crazy and even with everything collapsing, we analyze the situation, we look at it again, we think of the total damage of the tariffs, how it's going to affect companies, how trade will be affected, so on and so forth. But you got to realize that we only import $500 billion worth of stuff from China. And that's our principal concern. The rest of the world is like, okay, things will be 20. You know, it's not everything. We do produce things domestically. It's we have a $28 trillion economy. Consumers spend $7 trillion. Corporations probably spend another $7 trillion or so on goods and services. So $14 trillion worth of goods and services is half of our economy. And you're talking about tariffs on, let's say China's half, 500, let's say 500 billion from China and 500 billion from Europe and blah, blah, blah. So trillion, 2 trillion, 3 trillion, let's say $4 trillion. Let's be generous and say $4 trillion worth of inputs get tariffed 30% on the average. So that's about $1 trillion out of 14 trillion in spending. That's going to be not even 10%. So then probably, you're looking at not a 30% drop in the S&P 500. You're looking at a 10 to 20% drop, depending on how the tariffs work and how they get absorbed and so on and so forth. And over time, the companies will adjust and move around it and will figure ways around things and to get things done without the tariffs and so on and so forth. And eventually it won't even out, but they'll be able to move forward with no worse than I think a 10% drop from where they were, even with these tariffs, because people freak out because they don't know how to do math, because they don't look at the big picture. Because you hear 102% on China. Well, but the problem is, it's only 102% if you don't change your habits, right? Like avocados a couple of years ago were $5 for a while. And people were like, I can't believe avocados are $5. Well, they're complaining. And I'm like, so don't eat an avocado. Find something else to eat and stop bringing home avocados and comparing and complaining about how expensive they are. It was like Chipotle too, and Chipotle's like, oh, well, the price of avocados went up and we're gonna go bankrupt. And it's like, what are you kidding me? I'm like, it's first of all, your guacamole is awful. It's like it's just blah. So just stop serving it. If avocado is making you go bankrupt, stop serving the freaking avocado. Find something else tasty to put on a taco. And they ended up charging people, and now they still charge people, even though the avocados are no longer expensive. So it worked out for them perfectly. Anyway, so where are we? Remember, we're not trying to make money on the spreads. They are insurance policies. Using our bounce lines, we're able to time these adjustments, just like we did on Friday, to take advantage of the overbought. Look at the RSI. See that? Overbought. 70 is overbought. 77, very overbought. Or oversold conditions. And by the way, yes, I have warned people not to go by RSI because the technical indicators are broken under a tariff. When you change the rules so drastically as to put tariffs on the way Trump did, you've broken the indicators. So this was no longer meaningful, but still there are, even though that's no longer meaningful, and I know that and you know that because I told you, even though it's no longer meaningful, that doesn't mean that everybody on Wall Street went out and changed their algorithms. They didn't all run and hire computer consultants, which they should have done, by the way, but they don't. They've got algorithms that say when the market pulls back 20%, you start buying this and you start doing that and you start doing that. When the RSI hits this, you start doing this and you start doing that. The Wall Street firms, the idiots who handle your money, did not say, oh my God, we have to drastically rethink our strategies because of the tariff situation, because it's changed the rules and our algorithms are no longer buying properly within the rule book. And that's why the market went batshit crazy and dropped like it did for the last few days, because they did not reprogram their algorithms. Their algorithms were dealing with the rule setup that they had put down when the conditions were very different. All right, basically it's like they fed their computers the rules for baseball, but now we're playing football, and the algorithms are still following the rules for baseball. It's like, well, it might have been a great strategy to win a baseball game, but this is a football game, and you guys are morons for having the same playbook. That's what's been going on. And I said here, our first move would be to double down on the bull call spread as it's less than 150 on the $10 spread. That's $4 in the money. That's a good deal. The upside potential is $1.8 million. So that one we need to change on, not on SQQQ. We changed our USO to move to a lower price, and oil fell considerably since then. It was 65. Now it's like 50, whatever. I think it's back to God knows. I think it recovered somewhat. Yep, the Russell's up 8%, 1902. Wow. This is so fun. That is just insane. All right, so it's time for the Fed. And I did it perfectly. We got through that whole thing there. What I didn't get through, somebody remind me, I didn't get through the 10 stocks to buy, which was our next move. Once we had our hedges set up, we then started buying some stocks. And somebody in chat this morning was just freaking out because the stocks we bought on the 24th of March were not doing well. And it was the same thing. We bought those we bought when there was a 10% sell-off. So we bought some stocks when there was a 10% sell-off, and then we bought 10 more stocks when there's a 20% sell-off. And you know what? When there's a 30% sell-off, we would have bought 10 more. And when there's a 40% sell-off, we probably would have bought 20 more, because that's insane. And why is that insane? Because we already predicted the 20% sell-off, and the tariffs don't make it more than 10% worse, because math. That's why. The math I just took you through is why it's not worse than a 10% sell-off. So even though we thought we should have had a 20% correction, and even though they added the tariffs on top of what we thought was bad with the economy, it still doesn't take us down to 40% off. So therefore, when we get down around 20% off, we're kind of excited about buying things on sale. And not haphazardly buying. We're buying stocks we think are great. And in this case, we're buying stocks that we think are tariff proof. Fed, right, Fed. I'm like, what am I doing? Oh. My poor brain. There it is. This is exciting. Warren's gonna freak out. He's gonna be like, what are you talking about? And by the way, this whole thing is going on right now. It could be like a tweet that is gonna get taken back. That'd be funny. All right. Oh. Guess what? They just what is this? Woo! That's good because I'm in no mood to read that shit. Let Warren do it. NVIDIA up 15%, Amazon up 10%, Microsoft 8%, Alphabet 7.5%. The NASDAQ composite is up 10.28%. Wow. S&P is up 8%, 10-year 4.38. Listen, more than 75 countries have contacted the US. So if anybody who kissed Trump's ass is going to be delayed 90 days, all you have to do is give him a little smooch. Goldman Sachs 8.5, Morgan Stanley's up 10%, Citigroup's up 8.5%, Wells Fargo, why would anybody be buying Wells Fargo? Wells Fargo's up 6%, Boeing is up 13%, Boeing, Apple's up 12%, American Express up 11%. Look at these trains leaving the station. Holy cow. This is the stupidest day I've ever seen. All right, March Fed minutes releases a gold mine coming on the post-tariff euphoria. The GDP now shock. Well, it won't be minus 2 points, but this is going to go way up too because it's going to be the shock. The GDP was being calculated based on the tariffs, and now there's not going to be tariffs in Q2. Or in, oh, I'm sorry, in Q1. No, Q1 was already knocked down. It's Q2 that'll be better. All right, here's the breakdown. The Fed left rates unchanged, but significantly slow quantitative tightening, slashing the cap from 25 to 5. So they basically stopped it without stopping it. Key themes: high economic uncertainty because of the policy, upside inflation risks, especially from tariffs. Think about how these things have now changed already. Downside employment and growth risks, growing internal tension about how QT should continue, labor market broadly balanced, and some openness to rate cuts if the outlook worsened, but concern about lingering inflation. Waller dissented, opposing the QT slowdown. Yes, I think that was awful. And urging reliance because they still got a $7.5 trillion balance sheet. That's insane. The Fed's supposed to have a $1 trillion balance sheet. Detailed that. So even at the pace they were doing it, it was going to take them 20 years to work it off. You know, saying we're going to take $5 billion off of $7.5 trillion every month, or not every month, it is every month. Every month, that's like never. You're never going to fix the problem. QT shift. So that was stealth easing. The Fed cut Treasury runoff by 80%, and the most dovish action in a year. This is not neutral. It aims to avoid unintended reserve scarcity. And in other words, but if the Fed is trying to sell off their notes while the government's trying to sell off their notes, they're competing with each other and causing and because there's an abundance of notes, the notes then have to offer more money to bidders to get them interested in buying them, and that was bad. The repo market signals and shrinking reserve rates usage indicates tightening fatigue, as the Fed insisted has no implications for policy stance. So don't be fooled. This is monetary easing in function or not in name. Oh, he's so good, isn't he? Inflation view, sticky tariffs. Inflation is eased, but it's still sticky. Tariffs are a major new risk with uncertainty and magnitude persistence. Many businesses are already raising pricing concerns. Some say consumers may not tolerate more hikes, and they worry about inflation expectation rising. And the Fed knows the tariff inflation is coming, but doesn't yet know how big or how long it'll last. Expect more price stickiness, especially if China retaliates, which we now know that they have. Besson declines to call trade tensions with China. Trade war, says China has escalated. Oh my. Walmart's up 10%, Target's up 9%, Costco's up 5%, Home Depot's up 5%, who just got downgraded this morning. The Dow is now up 2,400, crossing 40,000. NASDAQ's still up 9.6%. American Airlines 16%, United Airlines 22%. Oh my God. Wow. This is so crazy. Spending moderated, layoffs creeping in the federal contractors, immigration restrictions could crimp the labor supply and push up wages. CapEx is paused across many industries due to policy uncertainty, agriculture sector strain. This isn't full-blown recession panic yet, but the Fed is seeing the contours of contraction, especially with Q2 expected to absorb the brunt of new policy shifts. Risk, this is a really good report. Almost all participants say inflation risk to the outside, but now most also say unemployment and GDP is to the downside. Higher inflation restraint, but growth fears. Balance of short tensions brewing on RRPs is almost exhausted, down to 59 billion. The reserve balances are due to TGA drawdowns and could drop fast. The Fed sees hitting of minimum wage reserve requirements with no advance warning. Some QT slowed further. Liquidity is getting tighter under the surface. The Fed knows it may need to reactivate balance sheet support if the market signals flash red. So they're aware. So it's good also. This is a good report because the Fed's aware of what's going on. Oil is up $2.25. I'm not sure what that means though. What's the basis of it? Delta up 21%. Oh, and semiconductor up 19%. That's one of the ones we had. Oh God. Wow. Now you see how upset we would have been if we had like bailed on all our positions and stuff. It's like because you get these crazy rebounds. And that was the point. It was a self-inflicted wound. This whole thing was just we did this to ourselves so we could undo it to ourselves like that. Just snap your finger. The market's just got a double dose of sugar with a 90-day tariff with a huge easing impulse. Today, 6 to 8% bounce, consistent with forced short covering and by the pause euphoria. The macro picture still stinks. I love him. GDP now at minus 2.4. VIX is near 50. Not now. I guarantee the VIX is not 50 anymore. 10-year at 4.4. Where's Mr. VIX? No, down 22%. Wow. Back down to 30. That's a pretty immediate thing, right? And that means drastic changes in all the portfolio balances because of the options we sell is crazy. The Fed is behind the curve again. They see the problems, but are responding with piecemeal adjustments. Playbook for members. Liquidity fragility, stay in high yield liquid assets, short durations, treasuries, and cash, recession hedging, add defensives, put spreads and such, stagflation, maintain exposures to gold, energy, inflation-linked bonds, avoid housing and CRE, trade tariff, be cautious with auto, semis, and exporters. Yeah, he's right. You know, we don't know yet what's going on, but we got a huge reprieve. Now we have 90 days to plan out. Now we have 90 days to plan better for the exact same thing. You know, unless, you know, as we find out more information about the tariffs over, thank God, 90 days now we can really analyze which stocks are going to be most affected. And we can certainly see from the charts now which stocks were taking the biggest hit. And if those issues are not resolved, we can expect to go back there 90 days from now. The Fed blinked on QT. The market thinks it's a pivot, but it's a crisis management maneuver in slow motion beneath the surface. The cracks are forming. The next inflection point may come not from the Fed, but from a credit event as reserve scarcity issue or political misstep. We're in a period of false calm powered by a pause button on tariffs. Not a true fix. Be nimble, be skeptical, and be ready. Let me know if you want this. Okay, great. You see how that was? All I had to do was talk to him and tell him what was going on, put it in context, and now he can really understand what he's looking at. You have to realize that with your AIs. Are they up to date? Do they know what's going on? And if not, you got to tell them, fill them in. Let them do their job properly. You have to give them information. You can't just expect them to know everything right away. Woof, crazy. I gotta put this into the chat room so people have it. This is how I do my job. I go like that, and I make a little Warren sign, and go like that, and we go like that, and we go paste. Doesn't matter. March, giving off a delay. Now I'm gonna make all the spaces. That emoji didn't work. Woo. Oh, another emoji that didn't work. I don't need him to say overview summary. Here we go. Oh, okay. Wall of dissented, bloody, 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 blah. He uses a lot of emojis that aren't getting picked up here. Why is this? This is not normal. Where's all something weird? Like every emoji is not working. Huh. Right? Number 4, risks. See how much work I have to do? Okay. Ah. Why did none of his emojis work? Da-da-da-da. Liquidity. Do-do-do. Do-doop. Do-doop. See, this is why I miss things sometimes. I spend so much time just trying to make it readable that I forget to proofread it. Stagflation hedge, bonds, avoid housing, blah, blah, blah. See, this is his table, right? He made a very nice table, but it doesn't work at all in WordPress. So unfortunately, it just kind of comes out like this. The Fed blinked on QT. The markets thinks this is a pivot, but it's price of management, blah, blah, blah. You ever read that? Oh, that. Da-dum, da-dum. Very nice. How great is it to have that kind of commentary like instantly after the Fed report? No, nobody other. Oh, here's a question. Just in time before the tariff wars announcement. Yeah. Yeah, because we've gone over the strategy. Anyway, okay, so now it's 2:15. There's not going to be any kind of announcements or anything like that. MicroStrategy, 22%. ARM Holdings, 21%. AMD, 20%. Oh my God. Woo. What a freaking day, huh? So let's take a look at the stocks we wanted to buy. Oh, we did buy. That's from yesterday already. Speaking of AGI, I just like give me a picture of a bunch of what did I say? I want a gang of a gang. Oh, I had a good word for it too. Anyway, I had a good. It's very important to use a good descriptive word when you're telling it to do something, but it wasn't a gang of children, but it was a something of children, like a. I said, just give me a picture of a gang of children building a Tesla, and that's what that's what it came up with. It actually came up with like 10 different things, but that's one I used. This one that one I made too with the AIs. So where were we? Oh yes. So yesterday I think it was. Been a busy week. Yes, yesterday was the 8th. So yesterday we decided to do some more shopping, and I started out saying that these are 10 stocks to consider in a turbulent market, and I wasn't going to use them for, see, so this is from Bodie and I. Bodie is our research AI. So Bodie and I had been discussing during the morning what would constitute stocks that we want to jump into, and what should we be looking after. What should survive the tariff regime as we saw it, and what were great values, and they also had to be great values in the first place. So our picks were, and we made a trade for each one. All right, so these are wonderful little descriptions. So it's good for if you want to add something and take a look at who didn't move way too quickly now. These charts are not for today. They're static. They only go to yesterday. But we liked T-Mobile, and their focus on domestic wireless service and internet makes them a resilient player in the tariff economy. Telecommunications are essential. People aren't going to throw their phones in the garbage because of tariffs, making the company less vulnerable to economic downturns or trade disruptions. And their strong free cash flow and their 5G network is also good. 5G, very, very slow rollout. I mean, most of us still don't have it on a regular basis. And so for T-Mobile, we did a backbone trade. We sold some puts. We did a uneven bull call spread, which allows us to, without any fear whatsoever, sell the short calls to generate an income. And this is a nice little play. General Mills, people are going to eat food regardless, right? And just for example, let's see if we can get take a look at how we're doing. TMUS. So not much of a move here. T-Mobile is still a good bargain. And what was the next one after that? I don't remember anymore. Oh, brain. General Mills. Oh, it's awful. I don't want to go see now. GIS. Whoop, not GUIS. GIS. Oh, and they're barely up too. Oh, we're finding we got some good ones that aren't really, but why is that? Because these are not risky plays. These are solid plays that we thought would handle the tariffs. We didn't pick them because we thought they were going to explode up. We just want them to stay steady. And as you can see, we're using them for income generation too. So these are solid trades. Can still get into them. Then we've got CVS. CVS definitely benefits because they just upped the reimbursements for the drug companies. CVS. That should be a good one. Up 2.8%, not very exciting. So essential services and the Medicare payment increase of 5%, that's huge. That's like basically drops to their bottom line. Because they already planned on their numbers were already planning without an increase. Now they got the increase. So what do? We sell some that should say puts. Shit. So we sell some puts. Edit post. As my number one sin is I mix up puts and calls. It's like a real mental block. Usually we're saved by the fact that the prices don't match, but puts. Dun, 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 dun. Date. Oh. View the post. All right. So CVS. So they've all got some kind of catalyst. ELV, another healthcare, also helped by the same thing. And you know, the thing about that is when you have a change in the Medicare reimbursement to the healthcare companies, that's a full year catalyst. They're not going to change their minds. That's a government allocation. So that money is going to come in all year long now, and you can just figure it into their results. So, you see, we caught a nice bottom, and now we're steadily going up, and all of these trades have a similar characteristic where we are selling short-term puts and calls. Oh, I'm not Elevon. Other than these guys, Elevons, other than Elevons, we were selling short-term puts and calls. Wait a minute, is this weekly? Daily? It's daily. Oof, what a weird chart. So that's good. We picked almost the exact bottom on these things. And I said, nothing too fancy here. It's an expensive stock. We might get more aggressive later, but let's make sure this is the bottom first. Union Pacific. So, you know, whatever the price of the goods, they still got to go from place to place. So we like that one as a play. And they're up 7% today. They took off right away. All right, Union Pacific is positioned to benefit from reshoring efforts as companies move production back to the US, increasing demand for domestic freight transportation. The company's fuel efficiency initiatives and long-term contracts with inflation-adjusted pricing. And by the way, if coal comes back, how do you get coal from one place to another? By train. So that's a huge thing when you see them talking about bringing back coal. You know, coal transportation, coal has died in the US. If Trump brings it back, we don't have enough trains and freight cars to cover the coal shipments. Because it, you know, used to be a significant portion of our total transport was coal, and it's gone to extreme decline. But again, we're selling 10 puts. We're buying an uneven spread. That leaves us upside potential, right? So we have uncovered upside potential. Then we oversell one of our uncovered calls, or one of the uncovered calls here. And then we also sell some puts because we thought it was way too low. When we aggressively sell puts like that, we were at 211 and we sold the 220 puts. That's how you can tell how bullish I am. So if I'm going to really aggressively sell short-term puts like that, that means I think it's way undervalued. If I sell below, it means I still think it could fall further, right? If I sell it at the level, it means that I think we're at the bottom. So depending on where my puts are sold in situations like this, you can get a pretty good idea of how bullish I am. So in this case, we very aggressively sold puts. We sold $17.50 puts. It still puts us in for 203 when the stock is at 211. So we're down here is our net entry, which has been good support going back last year. See that line pretty much held up all last year, had a little dip below, but basically you can say the 200 line was great support. The 190 line was incredible support, and we're selling the 220 puts for $17.50. We're at 202.50. So, and only 3, and we'd obviously roll them. Notice on the longer term puts, we sold the 170 puts for 15. That's net 155. That's insanely low. Yeah, it's probably not even on the chart. No, net 155 would be like down here. That's just not going to happen. So that's just free money. I mean, if they're going to pay you, they're going to pay you $15 for the 170 puts, and all you're doing is promising to buy Union Pacific for 155, which is probably less than 10 times earnings. That they're just handing you money for free. And we took it. And you know what? Because we took it, we netted into a $105,000 spread for $24,000. It seems to me it should be lower than that. No, I guess it isn't. Okay, we met into a $105,000 spread for $24,000, and we have 334% upside potential. And we sold $6,000. That's 25% of the total of the spread. We sold it, and we have 5 more chances to and that would be 124% more. So we could totally pay this off just selling short puts and calls over the next 2 years while we wait to see if we get $105,000. We can reduce this basis to 0. Love those kind of plays. Acuity. Why do we like Acuity? Because they are lighting and building controls. They benefit from Mexico because they're in Mexico. They benefit from Mexico's exemption from the tariffs on this because it's all under NAFTA. Gives it an edge over the Asian competitors, and it's a good business. It can scale up. We did the same kind of thing here. Notice 5, 10, 10. We sold 3 shorts. So we didn't take a big chance. We sold matching puts and calls, and we'll see how that goes. But we generate a lot of income off a play like that. And how are they doing today? AYI. Oh my God. They're up 10% today. So, ooh, what did we sell? We sold, oh, good. Oh no, it's exactly in the middle. They're at like 240 or, oh no, they might be at 250. Wait a minute. What are they at? Yeah, they're 246. But you see, what did we sell? We sold the 250 calls, which they're below, and we sold the 230 puts, which they're above. So this is exactly where we want them to be. And if not, it's only 3. We will roll them along if we have to. Steel Dynamics. Steel Dynamics is benefits from the steel tariffs. And they probably aren't going to get a big move because this isn't helping them. Taking the tariffs off is not helping them. Oh, no, they're still up 10%. Crazy. Okay, so they're up 10%. They were at 113, so now they're at like 125 or something like that. And we sold the 120 calls, so we're going to get a little bit of trouble on the calls. And we sold the 110 puts though, so we're going to make 10,000 here. They're only $5,000 in the money so far, and we're going to roll those ahead and do that. We have a 3750 credit on a what? On 150, 60. What is this? How come it's such a weird number? I mean, it should be 30 times 50. Should be. Oh, I see. No, it's 150. Okay, it's $150,000 spread plus the credit is 153,750. That's why. So we have 4,100% upside, and it's right on track. So these spreads, this is a good $500,000 or so worth of upside that's already working really well. Then we have Newmont Mining, which is my second favorite gold company next to Barrick Gold. We already have Barrick Gold in every single portfolio we have. So I was even typing gold because I can't remember not to. So Newmont Mining is up a nice 8% today. Perfect. Metals and manufacturing, why it's a buy. Surging gold prices, same reason Barrick Gold. Domestic producers selling globally priced commodities. They have inflation protection and tariff insulation. So there's a lot of good reasons for them. And again, same thing, sell some puts. Notice they're high puts. So Newmont's only at 45. So I sold the 45 puts. Buy 35 calls, sell 30, 55, 50 calls. Notice the 50 calls they're now in the money. Oh, nope, not quite. A little off the money. They're almost in the money already. This whole spread is almost in the money. And then we sold some short calls for August and some short puts for August. And it's net 68.50 on a $52,000 spread with 666% upside potential at 50, which is now only $1 or so away. And we have 4 more chances to collect this spread money. So that's bonus money. It's just bonus money that we're collecting along the way. Dollar General, love them for this kind of stuff. Look, for tariffs, whatever country is not being tariffed is where Dollar General is going to buy their crap from. They're going to go to each country that has low tariffs and say, what kind of shit do you have to sell me that's less than $1? Because that's all they have in the store. Any completely random garbage that is less than $1, well, even now it's really like a $2 store now. But they aren't loyal to China. They will buy from whoever has really cheap goods. And believe me, they might have Chinese suppliers that have been giving them half their store for years, but that doesn't mean they don't know how to pick up the phone and call Africa and call Guyana and go to Central America and have people make some stuff there. There's lots of people who will make trinkets for $1. So, you know, it's silly to write these things off because you hear the word tariff and go, oh my God. And let's see how the investing population voted on this thing. Oh, they're down today. That's weird. All right, but do we care if they're down? Let's see. We sold the 100 puts, aggressive, right? Sold the 100 puts a little over the thing. We bought the 80-120 spread. They're right in the middle of the 80-120 spread. But we sold $13,000 worth of puts and calls. We sold the 90 puts. Those are safe so far. We sold, oh no, they're not really safe. We sold the 90 puts. They're probably right at 90 now. Ooh, 86.52. So they fell below that. So what's going to happen if these are 86.52? If it's below 90, we have to roll the 90s, but our break even is 82. But if it's lower, we'll just roll these puts to a lower strike at a longer month, and these guys will expire worthless. And meanwhile, if we have to, we'll roll the spread down a bit. That's the first miss we've had out of 10 plays. We had one miss so far. CarMax, and not a bad miss, but just, you know, one that's not obviously on track. Now we have CarMax. This is also probably not going to do better because the premise on CarMax was that the tariffs on the new cars would make the used cars more valuable, and that's what CarMax does. Wow, I don't know why. There's no real logic to that. So they're up 9% at 80. And what was our play? We sold the $75 puts. That was a good idea. And don't forget, we were at 75 at the time. Yeah, we're at 75. We sold the $75 puts. We bought the 70-90 spread, and now we're in the middle of that spread already. We sold the September 80 calls. We're at 80 now. And we sold the $75 puts. We're now over that line too. So we did play a little bit aggressive to the upside. We're already there. We'll probably end up, these will expire worthless, and we'll have to roll these to a higher strike. But that's all. But that's why what really matters though is that we have the $51,000 of upside potential on the spread. So it's a $1,700 credit on a $50,000 spread. The spread is completely on track. It's halfway in the money already. So we took this spread for a $1,700 credit, and now we're $25,000 in the money. And we've got an income that we're generating of, well, September's a long time, that's 6 months. So every 6 months, we're pulling in $15,000 worth of premium. So if all goes well, we can pick up $60,000 in premium on top of the spread amount. This stuff is fantastic. And again, these gains are so superb that it doesn't matter that we lost a little bit of money on the first batch because we went a little bit early, 10% above where we are now. In fact, we're no longer 10%. So I bet all those other spreads are probably doing good too at this point, or at least breaking even. And the point is, you don't know when the market's going to recover. You don't know when conditions are going to change. You've got to make your moves. You've got to have, even if you don't believe in it, even if you're worried about it, you still have to mechanically make your moves at the right points. And those points are when our bounce charts hit our levels, when our predictions come out, unless we have a super drastic reason not to do them, and that would be, let's say, earnings obviously could change our mind about a lot of these stocks. But from what we see, from the way the board is right now, these are the moves that we wanted to make, and we make them. You can't just sit there. You've got to move your portfolio and adjust it. That's why we took, on March 7th, we took a month ago, on March 7th, we took 1/3 of our positions, of our longs, and we basically went through every single long position we have, and we had about, 100 positions. We went through all the positions, and we took 30 of them or so and said, you know what? I'm not sure this one's going to survive the tariff thing. This one I'm not sure is going to survive the tariff. This one is too dicey. This one made too much money. and I don't want it anymore because it already made too much money. It's toppy. We went through every single position, and if there was any reason to kick it, we kicked it. And that left us with 60 positions that we said I would be happy if the market drops 20%, I would be very happy to double down on these positions. They're too good to let go of. And if they got cheaper, I wouldn't let them go. I would only buy more. Those were the ones that we left in our portfolios. Then we added back whenever it was, March 24th. Then March 24th, after the market dropped 10%, we added 15 back. 1/3 of the positions that we cut, we added back. Then yesterday, we added back 10 more. But these are 10 new ones. And this is the key, by the way. So first we added 15, first we added back 15 that we regretted out of 45 that we cut. We added 15 back that we said, oh, you know what? They went down, they went down, they were cheaper. And we went back in at better prices. And we felt better that we didn't have them out of our portfolio. We regretted not having them in the portfolio. It hurt too. It's like when you break up with someone, then you go back like 2 days later. It's like, well, you don't realize how much it's going to hurt until you break up. So we broke up. We got back together with 1/3 of our positions. But then we also, yesterday, we went back and said, you know what? Here's 10 new positions we'd like to start sleeping with. And we picked those up. And if the market had dropped another 10%, we would have, well, first of all, if the market dropped another 10%, the first thing we would do is take the money we have, all our sideline money, and we would fix all the positions that were, that had gone down, that were damaged too much for us to feel good about. We would have fixed them because what I say, we kept them because we said we'd fix them when the market goes down 20%. So when the market does go down 20%, you can't abandon your plan to fix them. We cashed out the other positions. We had a ton of cash in the portfolio. We were waiting for a pullback, and then we say, okay, we'll fix them. But as you can see, with this rebound here, you don't necessarily have to fix everything. Foot Locker, 20%. Oh, that's one we kept. Nike's 11%. We kept them. Skechers, we kept them. They're up 10%. Kohl's, 24%. What the hell? Victoria's Secret, 20%. Gap, 17%, Five Below, didn't buy that one, 10%. That's split 20%, that's completely undeserved. Stellantis is one we have, that's up 17%. Ford we have, that's up 9%. General Motors, I don't think we added them, they're up 8%. This is so crazy. Damn it, guys, this is unbelievable. All the airlines are up 20%, wow. Anyway, so you see, it's a methodical thing though, okay? We cut when we felt it was toppy. We got back in when we had our first little correction on the ones that we regretted cutting. We cut a bunch of positions, and then after they came down a bit, we said, oh, you know what? That one I want back, that one I want back, that one I want back. Then we dropped down another 10% of the market, and we bought these 10 positions that we're looking at right now. And if it went down further, so at this point, we're going to get a bounce. We knew we'd get a bounce. We're having a bounce today. And if it went further down, we would then start doing some rolls in what we call salvage plays, improving the positions we have. And if it doesn't go further down, then we're fine. And if it bounces up, then we had no need to put our money into the other positions, which means we still have the money and our positions are improving. So unless the market drops 40% and we were wrong about everything, we have very, very many ways to win. And that's where we are right now. We are winning. We are winning big time. We're going to have insane amounts of money when I do the portfolio reviews next week, unless, of course, Trump changes his mind tomorrow and everything drops 10%, which could easily happen. But this is when you see the indexes going up 10% a day, that's the same thing as if they go down 10%. There's a buzzer. There's a limit to how much they're going to go up. And it'll take more than one day for people to buy back into this market. So we could have a whole nother big day tomorrow. And thank God we're positioned for it. This is so crazy. Anyway, joyous news. Good tidings. Thank you, President Trump. We are happy, happy, happy. JC says, I came late, and where can I find a replay? No, we finished the webinar. It processes or something. I don't know what happens, but it processes. It takes until tomorrow, and then usually sometime on Thursday or Friday or Saturday, they put up the webinars for replay, and they just write on the main page. You can see the last one, which they didn't put up until the weekend, is up now on the main page. And I will try to get them to do it sooner, because this has been a hell of a webinar. I got to tell you. I can't wait to hear it myself. Actually, I never listen to the webinars. I just feel like I said all that already, and it's kind of like weird going through it by, like listening to myself talk. Kyle says, I typically do all the LTP, STP trades, but I haven't been doing the butterfly and income. Do you recommend a percentage of your trades going to butterfly or income plays? Absolutely. The butterfly portfolio is the most steady money maker that we have. And I mean 20 years of testing. It is the most steady through up and down and sideways markets. It makes money. And I love it. I love it. I love it. It's not going to make the insane returns that we get from the LPT, STP, but those are aggressive, risky portfolios. It is nice to have steady income coming in, and that's what the butterfly portfolio is all about, steady income. So if you're wealthy enough that you're following the LTP and the STP, I would say, sure, take some money from the butterfly portfolio, take $500,000. Put it in the butterfly portfolio, those kind of trades, and it'll generate 100,000, 200,000 a year easily, almost all the time. Live off that money and let the rest of your investment grow. If you can live off that money, I mean, it depends how rich you are, but you know what I mean. But yeah, the butterfly portfolio it's there to produce an income and throw off cash. And it is wonderful at doing that because we're using our whole be the house strategy to make that stuff work, and it's a great example of it. Anyhow, kids, gonna get back to the chat. This is too exciting to ignore, and we will do all this again next week, all right? And God knows what's gonna happen then. Who knows what crazy decisions they'll make. But at the moment, I mean, congratulations to everybody who follow what we were doing, because we nailed it. Have a good weekend, folks. Take care.